Hey everyone, in this video I wanted to share with you one stock that's down 67.46% that I think you might regret not buying on the dip. Of course, the stock I'm talking about is also owned by famed investor Michael Burry. You know Michael Burry from his role in the movie The Big Short, or how he was portrayed in the movie The Big Short. He correctly called out the housing bubble and the housing financial crash around 2007, 2008, 2009. And ever since then, investors have been following and watching closely which stocks Michael Burry is picking. So this is one of the stocks that he owns. In fact, it's one of the highest percentages in his portfolio without giving away too much about the stock. So I'll talk about this stock's financial metrics, and then towards the end of the video, I'll reveal what the stock is. So let's get right into it. Starting with its revenue growth, total annual revenue for this company has grown from around $75 billion in 2019 all the way up to $155 billion in its most recent updated fiscal year. So revenue growth, very nice, very strong, very large scale business this company has. Now, that large scale has so far not translated to healthy operating profitability. Although, what I do like from this stock and what I have pulled up here is the operating profit margin over the trailing 12 months going back to 2019. What I like about it is the upward trend. You could see it moving nicely higher from close to negative 1% in 2019 all the way up to 2.34% in its most recent update past 2023. So 2.34%, you might say, is not an operating profit margin to be excited about, and I would agree with you. But two things to note here about this operating profit margin. Number one is the excellent trend moving upward, and number two, 2.34% might look small, but 2.34% multiplied by 155 billion still makes a lot of money. So a small percentage of operating profitability is okay when you're looking at companies with very massive scale like this company is here. Finally, the last reason I will note why I think you might regret not buying this stock on the dip, and why I think Michael Burry likes this stock as well, is the valuation. What I have here is the forward price to earnings ratio, and this company is trading at a forward PE of just 9.938, near the cheapest it has been going back all the way to January of 2022. So you've got a company that's growing revenue at a massive scale and increasing operating profitability, nice upward trend, and reached positive operating profitability. Additionally, the stock is trading at a relatively inexpensive valuation. So for all those reasons, I think you might regret not buying this stock on this dip here. So what is the stock? It is JD.com, one of the largest, if not the largest, retailer in China. So I'm bullish on the Chinese economy as it rebounds from the pandemic. I think growth will accelerate in the second half of the year, because the first half of the year, the economic reopening was slower than expected. So that means the second half of this year, or perhaps maybe next year, momentum will increase as that economy was more cautious coming out of lockdowns. And that's understandable because they were in lockdowns longer than any other country in the world. So I can understand why consumers were hesitant to, get out and start spending and really increase economic activity, because it's cautious. It was a fearful time for the citizens of that country. All right, for all those reasons, though, I think this is an excellent stock that I think you might regret not buying on the dip, and I can understand why Michael Burry likes this stock. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.